Hello, everyone. I'm Ava Vetterl, and I'm thrilled you're joining us today for this webinar with First Down Financial. I want to introduce you to my dad, Stephen Vetterl, a true leader in portfolio management and retirement income planning. His passion ignited during his finance studies at Xavier University when he tragically lost his father. That moment fueled his lifelong mission, securing families' futures, just like his own. Steve launched his award-winning career in 1998 at Fidelity Investments, crafting tailored investment strategies for high-net-worth clients. He's since co-founded First Down Financial, a fee-only Florida-registered RIA where he serves as portfolio manager. Before a recent merger, he built Benchmark Wealth Advisors as co-founder, head trader, and portfolio manager. He even guides aspiring traders through our sister company, FXES Traders. A recognized expert in technical analysis and auction market theory, Steve boasts a strong media following. Highlights include his time as an RVP at Fisher Investments, working side by side with investing legend Ken Fisher, and founding Augmented Capital Management, a tactical equity hedge fund. His accolades: multiple President's Circle and Chairman's Club honors, plus the 2017 Investopedia Top 100 Advisors Award. He holds FINRA Series 65 and 66 licenses. Off the clock, Dad's devoted to my mom, April, and my brother, Evan, and me, of course. He loves diving into the markets, Costa cars, boating, and a good round of golf. And without further ado, here's Steve.
Good evening, everybody, and welcome to the Retirement Rulebook, IRA and 401k Mistakes to Avoid. I am Steve Vetterl, Portfolio Manager, First Down Financial. I'd like to welcome everybody. Our hope with all of our educational series, which is what we're doing tonight, is that we empower you with knowledge. It's going to be really just from a high-level perspective, but let me just go ahead and share a screen. We'll get started here. So our PowerPoint tonight, hopefully everybody can see this, by the way. Let me know if you can't. The chat box is open if you would, please. Any questions at all, just as a housekeeping, you can put them in the chat box. I'm going to try and answer them all towards the end. Our hope is essentially to go anywhere between 45 minutes to an hour, leave maybe like 7 or so minutes for questions at the end, so forth. But let me just shift over to the presentation system. We'll get into this here. Okay. Let me know if you guys can't see this throughout the presentation. Just drop something in the chat box. I'm actually going to place that over here. I got 8 screens in my office and lots of craziness going on. But quick disclaimer, if I may, the information really is just educational of content. And, it's really not intended for any tax, legal, or investment advice, even though we've done this a lot. Steve and I and our team, we're not CPAs. We're not estate planning attorneys. We actually know a lot of really good guys in that arena. We guide clients to as an advisor, but really it's just not intended for any kind of solicitation. We're not talking about products tonight. There's no purchase of securities. It's really just speak to your own personal experts. If they aren't great, we'd be happy to talk to you as well. But the recommendations, and as always, everybody's so sick of hearing this, but I say it all the time, but past performance is not indication of future returns. Stocks and bonds, they're not FDIC insured. So just a quick overview, if I may. Ava talked a little bit about my background, but this is a team at First Down. My partner, Steve Ruff, his sons, Brody and Robert, they head up new business, client onboarding. Danny, to my left, case design. He is an allocation expert, and I essentially run all the portfolios for the firm at Charles Schwab. Let's get into our topic tonight, IRA and 401k mistakes and blunders. So this really is just going to be a chat about lots of the things that we see. We are a nationwide independent investment advisor, what they call an RIA. But essentially, we have clients all over the country. We know a lot of the rules depending on what's going on in retirement. We've helped captain many clients through very comfortable retirements over the last 25 years that we've been in this business. But just a wee bit on myself, as Ava kind of talked about, I've written a couple of books and won a bunch of awards. But with a lot of these events, the most important thing to me, and if you mind just sharing a little bit of a story here, the everybody's always, well, Steve, why do you do this? And, honestly, it really just has a lot to do with a tragedy, as my daughter Ava had mentioned. Hit the Federal family when I was in finance school at Xavier in the mid 90s. Essentially, my dad died of a heart attack, which is just a terrible function for the family. And honestly, even though we were really tight knit, it rocked us pretty hard. And essentially, with the luckily to my much benefit, with a number of the finance professors that caught wind of what happened to me, my mother was endowed a fairly sizable, not only life insurance settled, but my dad was a big executive and a big portfolio, and we had nobody to help us. So with the with sort of the help of a couple of professors at Xavier, we actually ran the portfolio all through college. And I said at that point, it was really my life's mission to sort of dive in and, help out families that have lots of misfortune hit them. But essentially, a lot of people will ask us, what kind of clients you guys deal with, Steve? And honestly, the clients we deal with, they're conservative investors. They've worked, 15, 20, some cases 40, 50 years for what they've saved, what they've invested. And they don't want to put it at large amounts of risk in retirement. They want to generate income from one or maybe one components of the assets that they have. But they're interested in traveling, visiting family, gardening, golfing, which I do very poorly, fishing, boating, which I do okay, and all kinds of other hobbies. So, really, the short answer is we deal with a lot of individuals and try and guide them through retirement and the complexities of the marketplace as a whole. So, this is a live event for those that just joined us. Everybody, welcome. Our goal tonight is trying to get everybody educated. This is a recorded event. So you will get the recording from Big Marker in the next couple of days. This is that fantastic presentation software that they have. Looks like we're running pretty good here. So if you guys could please stay focused, because I've got a really good material. I have some questions. I'll ask you to put some stuff in the chat box. Silence your phone if that's an issue for you. All the other tabs you're surfing through right now. Yeah, I know you don't want to look at my ugly face, but I got some good content to show you. But ask questions. And really, the key with the event in anything, at least from the clients that and prospective clients that we're meeting with, is I want you guys to grab a pen and paper or take notes on your phone or whatever, because I want you to really think deeply about three questions I'm going to pose. So if you're a self manager, if you are looking for some help, if you're just getting into the game, these are the three questions that are going to be most critical to your success in retirement. Number one, with all the uncertainty going on, not only in the marketplace, but globally, how is your portfolio engineered to navigate uncertainty? Okay. Is it engineered to take advantage of the good times, essentially the upside, right? Is the portfolio engineered to absorb losses? Even though we're fairly known in the industry as a safe growth expert, there are many ways to grow along with the market, but yet reduce a tremendous amount of risk against the uncertainty and the volatility. And the big one that I'm going to talk about here in a bit, we actually have a special offer to throw at you as well. But with the three questions, how's the portfolio engineered to navigate essentially rough waters, if you will? Is it in place to take advantage of the upside? Even though there is plenty of opportunity and chaos, and is the portfolio engineered to absorb losses? So those are the three things. And you're welcome to ask questions related to that. But those what we hear most from clients that we're able to help solve for them and to smooth out, if you will, without getting too much into the weeds. But with our offer tonight, we don't really do this much, honestly. And for those of you that stay with us to the end, we're going to have a special offer. And it really is, I'm not going to keep everybody in stitches because I can't keep a secret, right? But you can see it on the screen right now. It's a special offer. I'm going to actually organize a pop-up offer if I can do this correctly here. But with the pop-up offer, um, Here we go. Just restart your screen if you would, please. Okay. So with the special offer, it's a portfolio analysis. We usually charge about $1,200 for this. This is actually we hear a ton of feedback from clients that they appreciate that really this is the first time they've gotten such an in-depth analysis. Some have really called it a financial GPS, which I thought was kind of cool. But they really appreciated the fact that it was based on two things, and it is your truth and your true numbers. And I say that because there are so many financial planning software out there that use assumptions. And I would challenge you to stay away from any of that if it's presented to you. The software we use is one of the best in the country. It is very easy to understand from the perspective of the client. It's called On Point, but it is a beautiful risk analysis that the client has a questionnaire. We upload their statements, and it does an entire analysis of all their accounts depending on what the goals are, right? The goals in retirement may be growth still, with maybe taking some income. You may have a legacy as a goal, you may have all three goals. So, and you may want to convert some of your accounts to avoid taxation. So, all of those things get inputted into the program, and it presents a proposal to you, which we will do as a special offer. And it's exclusive to everybody that signs up tonight. Now, I would to have this best essentially what's the way I should explain this, to have this way many I had a client the other day tell me, Steve, this was probably one of the most insightful reviews of my portfolio, and she's want to term the coin financial GPS. I thought that was kind of cute, but it provided her a pathway through retirement. So let's go ahead and get into presentation. So, top IRA and 401k mistakes and blunders. Start off with just a brief history of retirement plans in America. And as many of you may know, it was 1935 that they signed the Social Security Act. And they really did this essentially to provide income for American citizens. And they had a much lower life expectancy than they do now. And they didn't really want it to be like, a complete solution, but it was essentially just to help augment retirement income. And supplementing personal savings really essentially is not to replace or lessen the dependency, if you will, on the government. So in 1974, they passed the ERISA. It's called the Employee Retirement Income Security Act. It's really the birthplace of IRAs and 401ks. It's essentially to give purpose in Americans an incentive to plan for their retirement. And what happened is the IRAs and the 401ks that helped establish, the changes to it over the next couple of decades. And we're going to get into the Secure Act, which is definitely a part of the most important reasons of the changes that have just recently happened in both Secure 1 and 2.0. But this is really the birthplace of everything. So gave Americans incentive to retire, want to look into the future. I think that the problem with the ERISA Act is that they offered incentives, but a lot of people didn't really understand how to use it in the back. So tax deductions on contributions, okay? A tax deferral on gains. So everything contributed to IRAs, 401ks, grows tax deferred. So if you trade the account around, you're in and out of funds or whatever, there's no tax on those gains. But the tax deductions on the contributions, and obviously that's not a Roth. You don't pay taxes and when you take distributions out of Roth, you pay when you put the money in. So my one piece of advice I'll give to everybody, just let the cat out of the bag. I am a huge proponent, if your employer offers it, to contribute to a Roth 401k as max as you can, as long as it's in the budget, obviously. But the key really is we come across and we run a lot of 401k plans for different types of employers as the advisor. We're not the bookkeeper or the record keeper or the administrator. We use two other firms for that. But I so often see 401ks that they haven't been modernized. They don't offer a Roth component, right? And a lot of people say, well, your employer can actually rehab the 401k, right? It's almost like a refinance. They can change the plan around. Then an administrator, if it's an old plan, they can replace it. But get that component in there because the power of tax deferred growth and completely tax free distributions in retirement is probably one of the most powerful concepts in all of finance outside of compounding. It's a close two. So you put those two together, and even though you may not be contributing a ton of money, do it over a long period of time, those accounts can still be really big. So it's payroll deductions, the other benefit, and the exemption from creditors. And we can go into all that if you guys want to in more detail. But in terms of just trying to keep it here, there's always a catch, right? So what's the catch? It's taxes and penalties. And what a lot of people don't understand is that the distributions are fully income taxable, not a Roth, obviously, but regular IRAs. And there's a 10% penalty for early withdrawal pre 59 and a half. It's a 25% penalty if you fail to take distributions after age 73. So Johnny turns 73 in November. Okay. Let's say it was in 25 last year. It's till April 15th when he files taxes to take his distribution. I typically don't wait that long, but he has or she has, any person that's turned 73, they have until April. And the following years after that, those distributions need to come out by whatever the last day of the year is. So we typically do distributions for clients, depending on what's going on in the market, somewhere between mid and November and December. So, stake of blunder number one, how the new Secure Act of 2019 will impact your retirement accounts. So, the real blunder is just not understanding how the changes since the 74 ERISA Act came along. It's just the changes. And the Secure Act of 2019 and the augmented one is the new rules of, and then there's a 2.0. We'll get into all that. But they had the most significant pieces of retirement legislation in, I'd argue, since 74, not a decade, right? And really what it did for us is it allowed new rules for IRA owners. So the old rules, grandchildren, children could spread the distributions and taxes over their individual life expectancies. Unfortunately, mom and dad die in an accident. God forbid, right? um, those children could have taken the IRAs, turned them into their IRAs, and just assumed distributions over an entire life expectancy. Okay. New rules, same group, any non spousal beneficiary, they must pay the taxes no later than 10 years after they inherited. Now, this seems like a really easy thing, but I can tell you, I have come across umpteen advisors who've lost the clients to us at First Down because they did not illustrate exactly how these rules should play out for the children. And announced to the parents in most cases, a lot of children just not executing on the wishes of the parents. So we've actually helped settle probably close to 25 estates for different clients. And really what we've been able to do is just offer them value on how to take distributions, let the attorneys and all that handle the paperwork as far as the executor of the estate. But a lot of the estate planning stuff we offer in our wealth strategies sessions for clients, we can actually guide the children through the spousal beneficiary, and set up the most effective plan. And that's, don't take it out on year one if it's a large account, and don't wait till year 10. So it's 10 years to pay the tax. And the non-spousal beneficiary options, just to illustrate a little further, you can liquidate the account immediately and pay all the taxes. They could spread the distributions and taxes over 10 years. They can wait until the 10th year to take a fully taxable distribution, which obviously we argue against. So let's talk about changes to RMDs. Now, RMD is a required minimum distribution. The Secure Act 2.0 will impact the following. So RMDs will decrease to 25% of the RMD amount not taken. Used to be 50. And I have at least 6 stories of people that didn't understand the distributions and they wound up paying a 50% penalty, which was lifted for a period of time during COVID, as you may know. But beginning immediately for any in plan, let me just highlight on it here. So they'll decrease. So if you turn 73 in 2025, the age has been raised to 73. You now have till in December 25 and no later than April 1st of this year if you turn 73 last year. So those are the new rules. So the key is just proper planning, make sure that you have these discussions. And I wouldn't wait till retirement to have these discussions with us if you wish, or whoever your advisor is. Let's get into mistake and blunder number 2. This is an improper beneficiary designation, and it can really impact your legacy. And so, fairly groundbreaking case was Kennedy versus plan administrator for the DuPont savings plan. And this is really a landmark decision, probably one of the bigger ones in 50 years, at least when it comes to beneficiaries. And essentially, the ruling says that the beneficiary form on the IRA application, so whether it's with a brokerage firm, a mutual fund company, insurance company, the bank, wherever the IRA application is, the beneficiary on that form trumps everything, regardless of what a will or trust or any kind of divorce decree or anything else says. So the story I have here, this is about 2.5 years ago. I actually have probably 3 or 4 stories, but I won't bore you with all the details. Basically, I had a client had been married for about 15 years, and the husband had passed away. And when it came time for her to request the proceeds from his IRA, they told her she couldn't. And this was a previous advisor. I guess it didn't make the changes to her or help her update it every year like we try and do in our annual review, or at least address the beneficiaries. It was not updated. So all the money went to his first wife, and it was just, let's say, a mess. So highly suggest that you look at this annually, if not every couple of years, when we suggest also looking at the trust documents in terms of review. So with the properly set up beneficiaries and or an estate plan, I'll take it a bit further in our presentation here. Costs and time of probate are just a monster. So if the beneficiaries are laid out according to one's plan for the legacy, for their decedents, it can avoid a lot of time and confusion. So just review through that. The disinheriting grandchildren component and or bankruptcy, all that stuff just needs to be addressed when you're looking at how to walk through it. So beneficiary checkup's important. Sound like a broken record on this, but believe it or not, I've seen some really poorly settled estates that we've had to come in and try and fix after the legacy and all the paperwork was really not laid out according to the parents. So mistake and blunder number 3 is not knowing this rule could cause immediate taxation. And I see some notes in the chat box there. Looks like a couple of you have already gone through some of this. So sorry to hear about that. But it's really not understanding the rollover rules and how they can cause immediate taxation. And with one screen. Let's pin this to the top. I see that. So I actually put the pop-up offer up at the top right-hand corner for you, Kathy. Sorry about that. In case, not understanding rollover rules can cause immediate taxation. So the simplest way to explain this is there's 2 ways to transfer your IRAs or 401ks. So if you leave, the best way to sort of illustrate this is if you leave an employer, get another job, you retire, you have, 6 401ks sitting out there. It is highly advisable that you consolidate all of them into a direct rollover, into one IRA, regardless of where the custodian is, right? It could be Schwab, who we deal with, or whatever. just get them rolled over into an IRA. Your options for investment are go up dramatically from the whatever 30 to 50 choices you have in a 401k. In many cases, the costs are considerably lower. Most importantly, you can get quality asset allocation and quality professional investment advice if you find the right advisor, right? But the direct rollover is essentially the best way to go. The indirect rollover is essentially where they send the check to you and then you got to deposit it to the IRA. So let's go in a little deeper here. The direct rollover is transferred directly from one institution to another. So the big 401k administrators out there, like the Fidelities, the Vanguards of the world, the some of those custodians, in most cases, when you complete the form when you retire, they will cut the check directly to the custodian. They may mail it to you, but it is made out to your IRA for the benefit of you at whatever custodian. And the best piece of advice I can give to everybody listening to this is that please make sure when you're filling those forms out, an accurate address for the custodian, an accurate account number, and essentially expediently getting the forms completed, always making copies of stuff that you send off or whatever electronic submissions you may make in your accounts online, that you absolutely track this, because we don't really run into a lot of it when we do a lot of this work for our clients in these rollovers. But I can tell you, we've had so many new clients come in where the previous advisors just completely screwed this transfer stuff up. And it could be just a mess to fix. So highly advisable to make sure you do quality work on that. But you don't receive the check, it's sent directly to the institution. You can do this as often as you want without any tax consequences. Okay. There's no mandatory 20% withholding because it's going directly to your account at the other custodian. So whereas an indirect rollover, kind of like I mentioned before, check maybe out to another custodian, but it's sent to you. It's kind of an indirect direct rollover, right? But in the old days, my kids are sick of hearing me say it, but essentially in the old days, the check would go to you. The client would deposit it, and then they'd send it off to their IRA account or whatever custodian, right? Which we don't recommend doing. So, but you have 60 days from when it leaves one custodian to get it rolled over into the other. And even though it seems like a real no-brainer, again, stories and mistakes on this, I thought it was important to include a detailed discussion how transfers should take place. But you got 60 days to do it. Check to use, 60-day deadline. Now, here's the key. You can only do one indirect rollover every 365 days. Okay. Hey, if you're not paying attention to this webinar and you're off in another tab, please click on the tab and take a look at this. You're only allowed one indirect, remember, not a direct rollover, one indirect rollover every 365 days, not a calendar year. Next story I'm going to share with you. New client, recent, bad advice given, did 2 or 3 60-day rollovers. He was only allowed one, and he did them all within a calendar year. It was actually liquidating a pretty large 401k. It was an executive plan, but just really bad advice from a previous advisor given. And he did 2 or 3 rollovers within a calendar year, and it violated the rule because they all took place within 6 months of each other. Half of the $400,000 of the second component of the rollover was fully taxable to him because he didn't understand, because they made the check out to him, and I think he got it in 50 days into the account or something like that. If the check cleared, he sent it, but he didn't know. He should have just done the whole rollover in one shot, which is what we would have suggested. So be careful on the indirect rollovers inside the same year. Obviously, it's 100% taxable because you blew the rules. So if you do an indirect rollover on June 1st, can't do another one to June 1st of the following year is a better way to sort of illustrate it. If done prior to the 365, it's immediately taxed as ordinary income. So mistake and blunder number 4. I use this story as the seed versus the crop, and it really is just in Roth conversions. Now, one thing I'm going to caution everybody out there that is just absolutely permeating the landscape in advisor land. And it is really simplistic, almost gotcha Roth conversion calculators that have been placed all over the internet. The vast majority of the data that they spit out is not based on a lot of assumptions. Ours has 14 inputs that are mandatory that we put in before the different Roth choices for the client, which is about 30 of them are spit out. Most of what we're seeing with these calculators, it's bad information. It's poorly run. You can't determine a Roth conversion for a client with just a couple of numbers. Okay. So just be real careful on that. So this number 4 is important because the way I explain it is that if you're retired or you're still working and contributing to hopefully a Roth component based 401k, you can put the money in. You don't get a tax deduction for it. Taxes are withheld on it, but it goes in completely tax free as its growth, the deferred of the growth. It's also completely tax free when you take it out. So it is beautiful concept for growth of your account. The key really is understanding if you have large IRA accounts, what type of conversion and when should it take place? Okay. So every client situation is different. We take them unique. We use the on-point software to go through the Roth conversion analyzer. But it's important to understand there's all kinds of parameters, but in its very simplistic form, you don't want to crash the client through multiple tax brackets to convert it, right? Because the problem is that when you set up the IRA, and let's say it was 2 years after the ERISA Act, right? You may contribute into the 401k and you roll over in an IRA. You essentially made a deal with the devil. And the problem is when it comes to Roth conversion, a lot of people are like, why'd you make a deal with the devil? I said, well, we'll let you grow this tax deferred, is really what the IRS and Congress said with this law. But you don't know what the tax rate is in the distribution. It's like having a 30-year mortgage or whatever the length of the mortgage, and you don't know what your interest rate is. So we say basically if the client has the money to pay the tax now, far better off. Everybody's situation is different. I get it, but it is far better off paying the tax now while tax rates are really low. They're probably going up with $33 trillion in debt. And for those that may have the goal of that account as legacy, then it's important to understand where it can grow to. Most importantly, beyond it growing to a larger, you're not mandated to take distributions out of a Roth IRA when you're 73 or 85 or anytime. So essentially you're paying the tax now, the seed, and when the distributions and gains are taken down the road, hopefully you have a major crop, right? Down the road, some cases we have many clients that have a Roth they converted. The goal for that asset's actually legacy. It could be children, charity, some sort of function of the church, what have you. But the cool thing is the accounts just can be a lot larger and you pay the tax up front and you have 20, 25, 30, whatever many years of complete tax-free growth. The other thing that changed in the law recently is they do not allow recharacterizations anymore. So I could talk for an hour on that subject alone, but just know that as well. Number 5, missing a required distribution. So I've already alluded to this a lot, so I'm just going to zoom kind of through this. But key is first distribution is due by April 1st of the year after 73. All future distributions are due by December 31st of all years after. Remember, this is not a Roth IRA. It is just a rollover or traditional IRA, or you can roll over a SEP, which is like 401k to an IRA. It's the same thing. Missed distributions cost a 25% excess tax. And a lot of people say, well, Steve, I mean, how many, you guys would be shocked the percentage of people that forget their distribution. The IRS is banking on this. Think about it. I mean, they made themselves look good by cutting it in half, right? It used to be 50%. you're still paying a 25% excess tax, and it's taxed to you as regular income. So do the math. That's over a 50% hit on whatever you didn't take out. I don't know what the percentage is. I see some questions in the chat box, but I don't know what percentage. But the IRS was banking on this when they when they set this up in 74. And that's kind of why I always joke, you made a deal with the devil, right? So understanding how the RMDs work with 401ks, this is an important I don't know, section, module, if you will. So 73-year-old example, 1 million in savings. Okay. Maybe they have 500K in IRAs, and there's a formula for it each year. It starts at a little under 4%, goes up from there depending on the mortality tables. But essentially, in this example, clients got maybe they're just turned 73, have a 13,250 RMD due by December 31st. The IRS doesn't care where you take it from. Okay, so think about that. You could take it from one account to just based on all the accounts values at the previous December 31st year, right? The year end. All your custodians will send you a statement on that if you haven't retired yet or haven't rolled any money over to an IRA. But here's the key. If you have a 401k, you got to take the money out of each account. You cannot commingle. Okay. So if you had a 403B, which is essentially just like a public sector 401k, equal amounts, you got to take it out of each of these accounts to get to your 13,250 total. So just remember that, because that is definitely a mistake we see. You want to take it out. And honestly, many of our clients are retired by the time they're 73. We're usually telling them to roll over to an IRA anyway, which helps avoid this potential error. But you can't commingle. So, boom, there's our fire pyrotechnics tonight. So, calculating them, 457s, 403Bs, 401Ks, they all kind of act the same in terms of the growth perspective. Number 6. By the time I get to these, it's almost like people are like, geez, Steve, you've been talking about this the whole webinar, right? Yes. So not rolling the 401ks, 403Bs, and TSPs, which is the government thrift savings plan, over to a personal IRA. So you always roll it over into a traditional unless it has a Roth component, and roll to the Roth. But you want to roll it over to a rollover IRA, traditional. They kind of act the same. Then, if you wish, we can explore doing a stepped conversion to a Roth. Again, each client situation is different, but why is that a problem? So if you think back to ERISA, and I know many 401ks have sort of modernized past this, and I'm not really sure this is like a negative benefit anymore. But in the old days, when I started at Fidelity back in the late 90s, we had countless people that maybe there was some sort of tragedy where husband and wife died, and the kids had a lump sum the entire 401k in 1 year because there was no contingent beneficiaries, right? So that was a huge reason, not number one, but that was a big reason to roll it over in the old days. So when you retire now, you can leave the money in the plan if you want. You can roll it to an IRA. Keep in mind, if you are employed and you're over 59 and a half, most employers 401k, 403b, it just depends on who the administrator of the plan is. They'll allow you to do an in-service withdrawal. So we have large amount of clients that are still working, but they have big balances in their IRAs or actually in their 401ks. They want to roll into an IRA. We can help them with that. You're still contributing to the 401k, so it's kind of slick. So just know you have more options in that. But you can also do non-hardship distributions. There's other benefits available. So the planning can ensure a lifestyle and a legacy for both you and your family. Number 7. Now, I alluded to this a little bit at the beginning of the presentation. Many of you that have seen me present before know that most of where I cut my teeth in this industry is as a portfolio analyst, portfolio manager, trader. Used to trade the futures markets quite a bit. I ran a bunch of portfolios for Ken Fisher. Is really where my expertise lies. That don't get me started because I can go quite tangential on this subject. But the volatility is really the enemy of your income. And why do I say that? Really, if you look at Robert Schiller. So if you don't know who Robert Schiller is, he's a renowned economist. He's actually a really nice guy too. So I got a chance to meet him a few years back. So he's a tenured professor, and his PE ratio index is highly, highly regarded by almost every valuation metric analyst on the street. Right now, it's at 40. Okay. Historically, was 15.8. That's the median. Okay. So take a look at this. The maximum this has ever been was December 1999. And for those of you who don't understand market history or don't know it, that was basically the top peak of the tech market run, and everything just got smashed in the S&P and the Nasdaq over the next 3 years. It's a terrible time to retire, which I'll show you on a couple other slides. So why do I show this? Why am I out there squawking on podcasts on this subject is because almost everybody we see come in as a client, they're way too heavy in stocks. Their equity component exposure is really high. The vast majority of the risk analysis in our special offer portfolio review is way higher than the risk score that they should be. So they're really out of alignment. And look, I get it. Equity markets have been running. I mean, they got clobbered in 22, as many of you may know. But they've been running hard for the last 3 years on a whole host of stuff. Our concern with this right now is that the meteoric rise of precious metals is a canary in the coal mine. Let me just tell you, there's no way gold and silver should be trading above 5,000 an ounce for each, respectively, or 100 for silver. It's nuts. What that's telling us, along with this ratio, is that maybe not necessarily be in a bubble, but man, we're really high in valuations. And every time you look at the times these metrics have lined up, almost always have we seen a decline in the market like we saw in 22 or 08 or some of the many other years. So why do I say this? Why is this important? Because understanding how volatility can affect your portfolio is critical in retirement. And God forbid you're the client that has a large account, rolls it over and looking to start generating income in retirement. You may not have the right team where that portfolio is in place as far as your money managers, and you take a big hit the first year you're retired. Think about the person that happened to in 22 or 2008 when it really got wrecked, right? You've lost a lot of money and you still need income off it. There's a really good chance, depending on your numbers, that you're going to run out of money in retirement and have to go back to work, right? It's like one of the more horrible things to think about in retirement. So not to be the bearer of bad news, but I mean, having a volatility discussion with whoever's managing your money, if it's you or whatever, and really the question should be asked of any advisor. You can certainly ask us. We've avoided the last 3 bear markets for our clients, but we're more of an asset allocator than we are just setting setting up a fixed allocation for the client, just letting it ride through any bull or bear market cycle. We just don't operate like that. And we don't believe in it. So the last indicator I'm going to show you guys is the Warren Buffett indicator. And, right now, I don't know if you guys have heard, but, Buffett's obviously handed the reins over, but, he and Berkshire Hathaway, they have one of the largest cash positions they've had quite a long time. And the Buffett indicator's at 223 right now, just under 224. Historical, anything above 135% is significantly overvalued. So understand how these can affect your portfolio. And as we tell everybody at the end of blunder number 7, proceed with caution. Okay. Number 8, not understanding the history of the market. So there's many ways I can have this conversation. I think the last couple of presentations like this, I showed it differently. All I'm going to say is this, just in the interest of time. Historical returns and market volatility are always changing. Okay. So if you look at this chart I have up on the screen, if you're not on the screen right now, you're on a phone. I probably would recommend watching this webinar on recording on a larger screen. My kids and my employees get entirely sick of me saying this, but I'm always telling everybody, put the damn thing up on a big screen so we all can go over it. And so from March 2020 all the way through the end of 18, this is a bit of a older chart, but I just love the illustration purposes of this because there's many, many stories of those that could not protect loss or did not have the right allocation. Again, not being able to weather the storm off that, right? Question number one, the uncertainty. It's the portfolio engineer to navigate uncertainty. Is it, set up to ride up with the markets and hopefully protected from the decline? But if you were somebody that retired in January of 2000 or in 2008, 2022, you had to draw income from that asset, you already started off with a really good bad year. And many of and this is that analysis thing I'm always telling you to be weary of. A lot of the assumptions that you're shown will show an 8 to 10% return. But when in reality, if you really look back at writing this whole thing out, many clients needed income. They couldn't just write it out. They had to take income from the portfolio. So the single most detrimental thing to a portfolio is if you're drawing income out of it, the portfolio goes down. So we structure it a little bit differently than most firms because we operate more like a hedge fund and how we run portfolios for clients. I don't really do much trading, but we operate differently in how we set and execute both tactical and strategic moves for clients. We want to write everything up, but we just want to reduce a lot of risk if we've gotten really elevated in price. We've gotten really overvalued, right? Bubble or not going to have that discussion. The key is to just look at the stats. Anytime we've been this high up in the marketplace, historically, we've always had a pretty good correction going forward. Doesn't mean it's going to happen this year, right? I'm just saying be careful with this over time and understand how this works. So if you were somebody that retired in January and you're taking income out of the portfolio, you basically get a 0% return for 13 years, right? Only finally in Jan of 13 did the S&P start lifting up out of that. So what does that mean? Well, that means that, your annualized return, and obviously it's probably about 1% higher if we ran this from 2020 to now, but you're not at 8 to 10%. You're anywhere around 6 right now. And, that along with the income that's taken out is really important to understand how that affects the portfolio. So last blunder, number 9, it's chasing higher returns in retirement. There's nothing wrong with that. If you're a really good trader and a self-manager, hey, hats off to you. The vast majority of self-managers I meet, they're too busy touting their returns that they get in good years, which is great. Hey, kudos to everybody, but I don't necessarily liken those two to a degenerate gambler, but I've met a few degenerate gamblers in my life. You ever notice they only tell you how much they won? So next time somebody hits you with that, just ask them flat out. It's more important for you to understand the losses you took than any of the wins. So I always ask those degenerate gamblers, hey, what's the total losses you've had over the years in relation to gains? What's that net? What's your gambling EBITDA, right? Your net profit. They're not going to tell you that. So if you're not drawing money out of these assets in retirement, sure, you can have more risk unless you don't have the tolerance for it. You can certainly have more risk inside the accounts. But just understand that if you are chasing higher returns, we call this strategy the if maybe I'll get some income. And if you look at this scenario here, so from 2000, I'll put the arrow up on the screen. So from 2000, let's say I roll over $1 million, it's easier to understand. This is more of an illustration of a real world example. You ever hear anybody presenting this and they talk about sequence of returns? It's just looking at how different types of returns, starting off poor, negative, great, whatever, fantastic, can have a dramatic impact on the account over a period of time. So the client retiring in 2000 rolls over $1 million. They need $40,000 a year, which is approximately 4% off the portfolio. It's doable. And they have to have that money, okay, to supplement everything else. So in their case, they started off with 3 bad years, took the account down to 510. Think about that. You had $1 million, and 3 years later, between income you took out and the account going down, you almost half your money's gone, right? I mean, you would just be crushed in retirement. And this happened a lot. And people say, well, Steve, you're starting off with 3 bad years. Right. That's true. But what if I flipped the sequence of returns around? You had 3 good years, right? And then you started drawing income and then you had 2 bad years. So it just, the key is don't lose large amounts of money. That's the key. Don't have the portfolio take some of these hits of 37%. 2008, the worst it was down. Intraday, it was close to 44%. But just to go through regular explanation. So there's the income, 3 bad years, as I illustrated. Past performance is no indication of the future. And as much as I argue with our analysts here about this slide, because our numbers have done better than this, they're like, well, just show the 4%. Okay, fine. So you have a 4 or 5% return. And actually, let me just go forward. Let's jump ahead. Same $1 million, same example, same longer period of time. We're looking more at just more of a stretch. Get 4% on your money. You can see you're really not touching your money. But if you're getting 4%, your $1 million never goes away, right? You're never touching principal. You're only pulling out income. This is certainly doable. The key is that you have inflation. There's all kinds of stuff eating away at that income need. It should be increasing as cost of living increases, right? But you can see you didn't lose the money, even though you had a low return. So the value of a portfolio is not in the amount of assets it holds. It's in the amount of income it can produce. Most importantly, don't take big hits. So ask yourself what's more important to you: eliminating volatility and securing your lifestyle, or chasing higher returns. So essentially, now's the time to take control of the portfolio, in my opinion. Lifestyle is the key. The special offer, just a little bit of more color on that, if you would. I have, and I made some notes on some of this here. Probably the biggest thing with this special offer is an exclusive meeting is really the cost that you save doing this. So typically, if you guys don't know this, most of these types of analysis, it's about $1,200, depending on the firm. Not all firms charge a fee. We don't charge a fee, but many do. And it's a fair amount of work for the advisor and or his or her team, but it's free if you click and set the appointment up tonight. Now, one thing, if you would please, we're all busy. We all got busy schedules, especially me. This offer will remain complimentary if you schedule it, and you can click on that link in the upper right hand corner, go to my Calendly. Make sure you click on the date in Calendly. So pick a day and then pick a time, but make sure you complete the information, you see it through. Calendly can be kind of finicky. So take your time on that, no rush. But if you guys hold the appointment time with us, it'll be complimentary. So while you guys are doing that, I'm going to double check some of our questions here. Let's see what we got. Wow, we got a lot of questions. So these are good questions, guys. If you got any, this is great stuff. So RMD stands for required minimum distribution. You got to take it. if you have an IRA and you are now over 73. Looks like there's a whole bunch of you are turning 73 soon. So I'll say happy birthday. One of the gentlemen here says, I'll turn 73 this year. I'm required to withdraw a sizable amount. How to invest this money and avoid additional taxes in the future. That is a beautiful example. If you would please, Rick, if you have the opportunity, book an appointment. We will go through all of the Roth IRA conversion choices for you. Next question involves, hey, Steve, I have a terrible story about just like yours. So thanks for illustrating that. You're welcome. A lot of bad stories out there about some of this stuff. Yeah, I mean, with the next question, we try not to be market prognosticators. One thing I'll tell you guys, I've been invited to go on Fox Business, and we know a bunch of guys that are presenters on Fox Business, but I was joking around with Charles Payne, a couple of those guys, and I said these guys are just talking their book when they're on Fox Business, right? Some guy's owning Nvidia. Maybe he wants to lighten up. He'll go on Fox Business, and he or she, they'll be like, yeah, we're adding Nvidia to the portfolio right now, and they may be unloading part of a position to reallocate, right? So I always say, look, there's a lot of smart people on television. Don't pay attention to their prognosticating. Pay attention to how they can help you with strategy. And with the next question here, the funny thing is, I don't know where it is. You guys could probably Google this. There's a Towers Parent study out there somewhere around. We used to talk about this a bunch back in the day. It's a bit dated, the survey, but it was a big to do. They did, I think it was for Acorn or Goldman Sachs at the time. If you have a quality financial advisor working with you on your team, you would be like a 2 to 3% higher return than for folks that just do it themselves. It's bananas. Now, the key thing there is that it's a quality advisor, right? I know I probably sound quite arrogant about this, but there is a huge chunk of the financial advisor industry that couldn't trade their way out of a paper bag. And there are a bunch of salespeople that are trying to sell you products and stuff like. The key is just find a quality advisor. That is our suggestion to you. We'd be happy to speak with you if you want to book an appointment. So let's see, any other questions? Thank you. Looks like there's a whole mess of people that have booked appointments, so appreciate that. So the recording of this will go out over the next day or so. One of the absolute things I just completely love about Big Marker is these guys handle all the TED Talks, by the way. It is just super sophisticated system. I absolutely love it. But they'll do the recording and it'll get sent out to you. Share it with your friends and tell them, hey, it's maybe the best hour of your life. And we'll show you what to do and what not to do. Also stay tuned because we've had a lot of requests for our estate planning. And one of our most requested has been our 5 pillars of asset protection. This is a big one. It's a little bit deeper of a presentation, but it is absolutely solid of just how to make all of your assets completely bulletproof based on estate planning. But I think I'm going to do the estate planning one next. So I wish everybody a great night. Hopefully this has been helpful for you. Yes, our webinar is over for those that just joined us, but the recording will be out to you guys in the next day or so. I would highly suggest you watch it, share it with your friends. Good stuff. But I'm wishing everybody a prosperous and happy 2026. I am Steve Vetterl, signing off.